Well, data has been weakening around the world, keeping hopes alive of rate cuts. Hi there everyone, welcome to the Traders Circle Weekly Market Update. Today is Tuesday, the 11th of June 2024, and before I get started, you do need to be aware that whatever I say is general advice only, and you have to consider whether it's appropriate for you. The big story this week will be the two major events happening in the US. On Wednesday night, they've got the CPI, or the inflation reading for the month of May, and then on Thursday, we're going to hear the results of their Federal Reserve meeting for June. Now, CPI is expected to continue to come in pretty slow, around 0.3% month on month, which is somewhat consistent with inflation slowing, but it's still well above the target range that the Fed would like to see. It really does sort of point to inflation remaining fairly sticky, and as long as inflation remains sticky, it's unlikely that we will see US rate cuts, at least in the near term. Markets are still pretty confident we're going to see a September rate cut from the Fed, and I think they were bolstered a bit in that view last week with the Bank of Canada and the European Central Bank cutting rates last week. Really sort of showing to investors, showing to the market that central banks can cut rates, rate cuts from the US might be coming, and we have seen a weakening in data in those places. Maybe data will continue to weaken in the US and indeed here in Australia as well. So we will see the CPI this week. If we do see the lower than expected CPI reading, I do think that could be a big benefit for markets, could trigger some upwards movement. I think we will need to see something positive like that for markets to keep going, because prices are extremely stretched at the moment. And even though we have seen fresh all-time highs in the US, the additional gains have been very, very incremental. Each successive high seems smaller than the last. So the CPI will occur the reading will come out on Wednesday night, and then we'll get the Federal Reserve meeting on Thursday. I suspect markets will move with the CPI reading, because I suspect the Fed meeting won't really reference that CPI reading. It'll be too close to the meeting, and the Fed meeting will have already started in essence. Markets will be looking for signals as to whether they're confident about a September cut, whether it's going to be pushed back towards the end of the year. It seems there's a really clear split in the members of the Federal Reserve, with about half of them favoring holding at higher rates for longer, and about half of them, but importantly, Chair Jerome Powell, favoring cutting rates earlier. So Powell will speak on Thursday night. Every last few speech of his has been quite dovish, and promoted the idea of further rate cuts or of rate cuts. And so, if that's the case, and he remains fairly dovish, we could see further upwards movement. If he is a calmer voice, a little bit more hawkish than expected, or if CPI comes out, worse than expected, there is a fair bit of room to the downside for global markets, given how much they've pushed higher, on the back of rate cut hopes. The other thing occurring this week is Australian unemployment. We're going to see that on Thursday Australian time, I believe around 11:30 a.m. Eastern Standard Time, and unemployment is expected to tick back down, believe it or not. It's expected to come down by about 0.1% to 4% unemployment, and it really does sort of show that, yes, maybe the jobs market is slowing, but it is a very, very slow pace of slowing that's occurring. Employment is remaining very, very strong, and in that environment, it's very hard to see prices coming, way back to the middle of the RBA's target range. So Australian CPI is still growing a lot stronger than the RBA would like, and it is for that reason that most economists aren't predicting an Australian rate cut until 2025 now. Now, I've said many times that those expectations can change very, very quickly. The economy is a giant confidence game, and the moment people lose confidence, data will weaken substantially in a very short period of time. So whether, so-and-so predicts a rate cut in, the first quarter of next year or the second quarter, all of that is kind of irrelevant if data changes substantially between now and then. And I suspect that, when the data does turn, it'll start to turn pretty quickly. Regardless, it's not expected to turn at this unemployment reading. I still think our market will respond to it. Bad news probably being good news, so higher unemployment probably a benefit for the market, lower unemployment probably a negative for the market. So that's going to be on Thursday at 11:30 a.m. Australian Eastern Standard Time. The other thing worth mentioning for Australian markets this week is iron ore. Iron ore's fallen over 12% for the past 2 weeks. It's really come off quite strongly, and indeed it fell an additional sort of 3.9%, I believe, at the time of recording, as it reopened from the Chinese public holiday this morning. So really a weak period for iron ore prices. This is a cyclically weak period for prices. Traditionally, this time of year, prices do come off, and they are starting to look back towards the lows of about a month or two ago, which again is probably another leg down from the current levels. It's in this environment that our iron ore miners have also been falling quite strongly, which makes a lot of sense. They're getting less money for their product, they're making less profits, and their share prices are coming off. That has been a drag on our market as a whole, and indeed, it's one of the reasons why we saw such strong selling today, despite global markets holding up around the world. In that environment, with our miners coming off strongly, it's up to the other parts of our market to do the heavy lifting. So we've seen the banks push to all-time highs, or at least near all-time highs. We've seen the insurers push up to recent highs. We've seen other parts of the market really have to pick up the slack with those iron ore miners coming off. In many ways, they're actually being pushed up by buying of our index. When someone buys a future or a forward or a call option on the XJO, that pushes every stock on the XJO higher. But if you sell down some of those shares, i.e. the miners, that means that those other shares have to rise that much further for that gain in the XJO to be realized. So with the iron ore miners coming up, the banks have picked up the slack, but their valuations are extremely stretched. They're already the most expensive banks in the Western world and only getting more expensive. And so it's no surprise today that we saw a bit of profit taking. So let's have a look at the charts for this week. And here we have the XJO. We can really see that it did push up last week with the US reaching fresh all-time highs, but it's been sold down quite heavily today. We've come back to roughly the middle of the range of the last few months, right around sort of 77.40, 77.50. If we do break below 7,700, we're then starting to look at the lows of sort of April, 7,600, 75.50. And if we push to the upside, our all-time high is 7,900 index points, really not that far away at all. With our market rising quite strongly, our miners have actually been coming off. So if we have a look at the XMJ, which is our materials index, we can see that it's really come off for the past fortnight. And this is dominated by BHP, Rio Tinto, Fortescue, and with iron ore falling, that's really pushed the material stocks lower. So while the materials have been a bit of a drag on the index, it's up to other parts of the market to do the heavy lifting. And so if we have a look at the XFJ, which is the financials, dominated by the banks, CBA, Westpac, NAB, ANZ, and Macquarie, they've really sort of rocketed higher over the past week and a half, just to keep our XJO pushing higher. So that's been sort of the story for our market over the past week. The material stocks falling, the financial stocks rising, and overall, our market's really done not much at all, holding around the middle of its range for the past few months, right around 77.50. Looking at the US market, they have been achieving successive fresh all-time highs, but their highs have been very incremental. So if we have a look back at the fresh high in May, they only exceeded the previous high by roughly at 1%, a little bit over, and they didn't really go beyond that level until they exceeded that high again in the past week. So when they did exceed that high again in the past week, they went even less than 1% higher. They jumped about 0.8% and seemed to have found a fresh all-time high right around 5370 index points. If that does break, we would expect further upwards movement, although again, I suspect it'll be incremental at best. And if they do break back below the previous all-time high, where I have it at roughly sort of 5320, I think we'll see a move back towards the uptrend line around 5260. Overall though, the fact that the pace of gains has slowed a lot for the US market does sort of suggest that the rally is running out of steam. Now, it might be rekindled if we see a lot weaker than expected CPI or a lot weaker than expected inflation, and that might trigger renewed hopes of many rate cuts in the last few months of this year. But overall, I do think that valuations are extremely stretched when we are seeing the bulls start to get a bit exhausted after such a ridiculous run for the past sort of 8 months now. So I will end it here for this week, guys. Hopefully you enjoyed. If you did, give us some love in the comments, click the like button, click subscribe, and we'll see you next time.